Okay, so we're recording. So I'm just going to go ahead and do my normal preamble that I do each week with inviting people to join in the conversation. Even though we have kind of a prepared format or forum, we can take this wherever people want to take it. And if we don't finish, that's okay. I'll just pick up where we left off. Tonight I prepared a rather long presentation, and I don't expect to finish it. But I wanted to prepare enough that I knew that I would have enough to fill the time and then some. And then, next time we'll start up with a part two. Anyway, as I mentioned, feel free to jump in, show us your smiling face, and comment on anything that grabs you. Tonight's presentation is going to be on modern portfolio theory. That's where we are in the book. This is where the discussion gets a little mathematical. And Ben, of course, reassures the reader that you don't have to be a mathematical genius or a mathematical guru to be successful in the shadow banking system. But I wanted to spend enough time tonight on the math that people can kind of get an idea of how things come together. And not only that, but it's important that even though we don't have to do the math, and I'll explain a little bit why, it is important that we do understand the definition of these terms and how they're applied. Because you're going to talk to investors and people are going to ask you, well, what's the beta? Or what's the Sharpe ratio look like? And those kinds of things you better know, what your alpha and your beta and your Sharpe ratios and things like that. And you'll probably also want to know more or less which measurements are what I would call process measurements versus measurements that actually are the indicators that you're looking for, the story that they tell, right? And so we're going to talk a little bit about those different things and how to calculate some of these things. And again, not so much to turn us all into quants, but to be able to at least understand some of the fundamentals behind it. So we're going to do that for a couple of sessions this week, next week. Maybe it'll spill over into a third, not next week, but next time. And maybe it'll spill over into a third. But again, it's something that I think you'll find interesting and fascinating as we dig into this a little bit deeper. And I'm going to try to focus on the story behind the numbers, not just how to calculate numbers. So that's kind of what we'll be working on tonight. Just so that everybody knows, the modern portfolio theory was developed by Harry Markowitz and William Sharpe and Jack Trainer and a number of people back in the 50s and 60s. And it's designed to develop a risk-adjusted performance analysis behind either an asset or a portfolio of assets. And so we're going to be looking at these things that they develop. And I bring this up because, number one, Ben mentions it in his book. And number two, just to emphasize once again that these are not secrets. These are not things that Ben came up with. They've been around for a long time. The problem is very few people use them. And part of the reason why they use them is they just don't understand them. They haven't made the effort to educate themselves in terms of what they are and what they represent and how they work. And so they get caught up in some of the more common analysis and mistakes. And of course, they rely on things like stories, feelings, relationships. And the modern portfolio theory is based on no, risk is a number. And if you understand that and you start and you know what numbers to look for, then you'll be able to assess risk more accurately. And so that's going to be what we're going to spend some time tonight taking a look at. So modern portfolio theory is that if given a choice, most people would opt for the least risky way to achieve their financial goals. People are generally risk averse. And when you use modern portfolio theory, you can build portfolios that are designed to maximize your returns given the amount of risk you're willing to take on. And so I mentioned here at the bottom, since its introduction in 1952 by Henry Markowitz, modern portfolio theory has become the key tool for asset managers typically apply to a buy and hold strategy. And so that's something to keep in mind. If you're looking to invest, or should I say trade, like day traders and things like that, then this may not apply quite so significantly. You're going to be focused more on the fundamentals rather than some of these risk management tools. But if you're doing a buy and hold strategy, which a lot of people now are trying to say, well, that's not going to be good, stay away from that. Well, if you know what you're doing in a buy and hold strategy, you can outperform even the day traders. And so that's just something to keep in mind, and that we'll have a technical discussion about. But if people have questions about that, we can certainly discuss that. So, when it comes to modern portfolio theory, one of the first things we need to do is take a look at the fact that you're going to be looking at a portfolio, or you're comparing portfolios, and you're going to be starting out with a set of data. Okay, so I've brought up a couple of data sets here that Ben features in the book just to have some conversation about. And you'll notice there that we've got the S&P 500, and we're positioning against the MSCI US REIT. Okay, REIT is an index. The MSCI is a real estate index. And so, we're going to do some comparative things between these two indices. And we're also going to compare that to Adagio's performance over the same period of time. So we'll be comparing how these different things look compared to the S&P 500. For starters, when we're doing modern portfolio theory and we're analyzing risk, we're going to be looking at a couple of standard performances, one of which is the S&P 500. In other words, everybody pretty much understands what the stock market is, and everybody pretty much understands how to compare, or I should say that they ought to compare what they're considering investing in, whether it's an individual stock or whether it's an alternative asset, against the overall performance of the S&P 500. And so that's why we kind of use that as the benchmark. And so we're going to be looking at these data sets. But when you hear Ben talk about going back in time to consider a financial crisis, at least one in your business cycle, he's talking about get enough data here to go back to include possibly the most recent financial crises. And so in this case, he's saying, go back to 2004, 2005, even 2006, so that you're incorporating the financial crises of 2008. If we had been in 2007, if this was 2007, for example, he would say, make sure you incorporate the financial crises of 9/11 or the dot-com bubble. Prior to that, he might have said, go back and include the financial crises of the real estate crisis in the early 90s, or Black Monday of 1980, 87. And so if you remember, there was a slide that we put in here a presentation or two ago that had all of these different financial crises about every 10 years. And so he's making sure that you include those, because essentially you want to include in your data sets the kinds of things that show a downtrend in the market, or the metaphorical black swan event, right? Because if your investment holds up during those difficult times, then it stands to succeed in good times. We're going into another financial crisis here. I know there's a lot of people, not amongst this group, but amongst other groups that you know, aren't ready to admit that we're in a financial crisis, but we are. And so in the years to come, you know, people will say, well, make sure you include 2022, 2023.
Hey, Mark, we lost you. You're frozen. You can hear us. Mark, are you there?
What might be helpful is ultimately getting to an Ethernet port. Right now, I'm at a resort, and I only have Wi-Fi myself. So,
Okay, he's back. He's back. There he is.
Okay,
I'm back. I have put an Ethernet connection onto my router, but my router is wireless, and so if I'm still having internet problems, then I could still get bumped. But hopefully, this will help. So anyway, welcome everybody. I went ahead and got started right at the top of the hour, and so I've given my usual introduction. Feel free to jump in with any questions to stop me if you want to do that, and go from there. Let me share my screen again. So there we go. So we were introducing modern portfolio theory, and I was starting with the data sets. So let's go in and let's actually look at some things here. The first thing I wanted to mention was, again, that there are some measurements that are process measurements, and then there's measurements that we can make conclusionary statements about the data. And the first one I want to mention here is geometric mean. Geometric mean, I'm not going to spend a whole lot of time talking about it because it's a process measurement. It's a way of looking at the average set of values in that data set, okay? And there's a couple of ways of doing this. You can calculate the average, and everybody pretty much knows how to calculate average in their head. You know, you just simply add up all of the data points and divide by the number of data points, and that gives you what's called the average. That is not the geometric mean. This is the geometric mean. And the reason why I don't want to spend a whole lot of time getting into the math is because the calculation of the geometric mean and the average, although different, aren't materially different to the extent that it would change your story. In other words, if at the end of the day you want to look at your expected return based on an average, great. Geometric mean is also easy to calculate, although this is the formula and it looks very, very difficult. You can do it very easily in Excel, and you know, highlight the data range that you're looking at. You can go into the statistical formulas, calculate mean, and it'll just simply get returned to you a geometric mean as opposed to an average. Okay, so that's really all I wanted to say about that. The geometric mean here is calculated by multiplying the different data points rather than adding them, and then dividing by the square root or the cube root or however many roots you have there in roots based on the number of data points. So again, the thing to emphasize here is it's a process data or process result. It's not going to materially alter anything, but it's important to know that it just functions as what I call the Euclidean average, because the process of coming up with geometric mean is a Euclidean mathematical formula. Okay, so let's move on. We're going to use that geometric mean a lot. And so that's why I mentioned that. Let me jump down here real quick. All I'm going to say is crapola. The internet's already starting to get squirrely on me.
Oh. Hey, Mark,
Yeah.
what is a Euclidean? What does that mean? I'm not a math quant person, so I'm like,
Let me see if I can get my name straight. Euclides, if I said that right, was a Greek mathematician.
okay.
And so, or Euclid. Actually, his name was Euclid, now that I think of it.
Euclid and Ulysses.
Yeah. So yeah, his name was Euclid. He was a Greek mathematician anciently, and he came up with this methodology of coming up with a geometric mean of, and he came up with a lot of other things as well. But primarily, he calculated the geometric mean as opposed to calculating an average. And again, I want to just emphasize for everyone so that you don't get nervous about the math. The difference between the geometric mean and an average, a simple average, is not materially different enough to change your story. If you're looking at, do I invest or don't I invest, and you're wanting to do some quick and dirty calculations, and you don't know how to calculate or don't have access to a spreadsheet to calculate the geometric mean, and you don't know how to do it on your TI handheld calculator, well, then just go with an average. It'll still get you there.
Was there a reason behind choosing to use the mean as opposed to the average?
It technically is more accurate, but we're talking decimal places now.
Yeah. I mean,
So,
I know. I went through it in statistics. They made sure we knew that.
yeah, I did too. I mean, I had to calculate that geometric mean. I think we might have been able to use our Texas Instruments handheld statistical calculators back then, but I don't.
Yeah, I remember that. Yes. Exactly.
But the point I wanted to make was, in that is here, and I highlighted this in red here. You've got your S&P 500 and your MSCI returns, and you look at the average down here, 6.4 and 6.92 respectively. I'm pointing at them with my cursor there. Those are even though Ben has them labeled as average, you notice down here, he says this is really the geometric mean. And so all you have to do when you've got a spreadsheet like this is highlight the range, and then click on statistic formulas, and then click on geometric mean as opposed to average, and you'll get the geometric mean. So I mean, that's, we're talking, minor difference, but I wanted people to understand the difference when you're in a discussion with somebody. At least in your mind, you don't have to know how to calculate it, but in your mind, know the difference between a geometric mean and an average, and what impact that would have on your.
Believe me, there's always someone who asks you, how'd you come up with that number?
Yes, yeah, and so it makes you look really smart, if you can say, oh yeah, I calculated the geometric mean, Jody can attest to this, that Orrin Claff, and if you haven't gotten the book, Flip the Script, then that's definitely an investment you want to make. But Orrin Claff talks about, from a marketing standpoint, being able to dazzle them once in a while with what's called a flash roll. And a flash roll is where you use technical jargon even to essentially show people that you're in a position so far ahead of them or above them from a technical standpoint that they don't dare challenge you. And so, and you can read in there how to do that, but learning some of these technical terms puts you in that position. And so, if you can, drop the term geometric mean or just mean, and they know you're talking statistics at that point as opposed to simple average, then that tends to wow people at that point. Your credibility points will go way up. And so that's why I threw that in there as a process measurement. And there's a couple others. So let's move on to some results type measurements, risk adjusted performance measures within the portfolio theory itself. And the first one I want to dwell on is beta. Okay, you've probably heard beta kicked around a little bit. And I spent a lot of time studying Investopedia. I highly recommend it for the reason that even though Ben gives some really good discussion and definitions and concepts and things like that, there are times that if you find it difficult to grasp or understand just the way he thinks and communicates, then go out to Investopedia, take the term that you're looking for to have it defined or whatever. They're inclined to communicate in what I call crayon language for me. And I can understand it a little bit better, and then I can come back and understand Ben a little bit better. And I can certainly understand it well enough to then explain it to others, hopefully sufficient so that others also understand it. So I highly encourage you to spend time in Investopedia if you're wanting to study this a little bit. But the first measurement's beta, and beta is defined as the measure of the volatility risk or volatility of a security compared to the market as a whole. So in other words, if the S&P 500 has a certain volatility level, is the investment you're considering, such as the MSCI REIT or Adagio, more or less volatile than the S&P 500? Because people, as a general rule, are pretty much saying that the S&P 500 is an acceptable risk of volatility, right? I mean, you look at all the trillions that are invested in 401ks, and obviously people are okay with the volatility of the S&P 500 as a general rule. Now, our eyes are opened and we know better, but we are beyond, I think, at this point, the typical investor. So when I say typical investor, I'm talking, the odd lot theory, right? The dumb money. And these are the people that are throwing their money in a 401k because that's all they think they have, right? So anyway, so the S&P 500 is the standard you want to beat in terms of volatility and other risk measurements. Okay, so let's jump into beta a little bit more. First of all, let's calculate beta. So there's the formula, and essentially what that formula says, I'm going to translate it from math to English. It says beta equals the covariance of the average return on the investment and the average return of the market. Okay, so R sub I is the expected return on your investment, which is your average or that geometric mean. And when you're comparing that return to the return of the market, in this case, it's the S&P 500, we calculate a covariance. And again, a covariance is a statistical number that is easily calculated on a spreadsheet. Again, you highlight your data set, you go into statistics, and you click on covariance, okay? It's not hard to come up with. This looks impressive, but it's not that difficult. So what you're doing is you're coming up with the covariances, and then you're dividing, or I should say the covariance of those two data sets, and you're dividing it by the variance of the market. So where do we get those numbers? I'm going to take you back up to this board right here. And if you look at what I've outlined here, this is a spreadsheet that Ben put together, and he literally, this is a cell right there on the spreadsheet, that 0.02892, And then up here is an S&P variance 0.03545. Those are cells. And what he did is he highlighted over here these ranges, right? And then he calculated what the variance on this range is, and he put it right there. He calculated what the variance is on this range and put it right there. And from there, he was able to calculate the covariance between the two data sets. Okay. Again, I'm not trying to make you mathematical experts. I'm not trying to make you spreadsheet gurus, but I wanted to explain it to you in as straightforward terms as I can to show you that this isn't rocket science. So in other words, we've come up now with the variance and the covariance. So if we come back to our beta, there's our covariance between the two data sets. This represents, in this case, the MSCI, and this represents the Standard & Poor's 500 average returns. And again, I forgot to mention, but there they are. So the Standard & Poor's had an average return of 6.4% annually, and the MSCI had an average return of 6.92 annually. Okay, over those years. And so they're very close when you think about it. We shouldn't expect a lot of deviation between these two data sets. They're that close, right? I mean, just looking at what those two things are telling us. So let's go in and look at it. So we take the covariance. If you remember, I pointed out that was 0.02892 divided by 0.03545. And it gives us a beta of 0.8159. Okay. So what? So what? What does that mean? Okay. And so there's several ways to interpret your beta. And so that's what I put here on the right of this board. If your beta has a value close, it says equal to 1.0, or I'm going to say close to 1.0, then it indicates that its price is actively correlated or strongly correlated with the market, right? Because the Standard & Poor's market as a benchmark is set at 1.0 beta. And so you're now comparing your investment's opportunity against volatility against the market beta of 1. So if it's close to 1, then essentially what it's saying is statistically it correlates with the market. All right. So if you look at the MSCI REIT, and this is something that you've probably heard Ben mention before, is that because the REIT has been essentially made into, or I should say the real estate indices have been made into efficient markets, much like the stock market, then it stands to reason that an index, a real estate index, is going to be similar to the market, right? And this proves itself out with a beta of 0.81, 815, 82 if you want to round it out. That's pretty close to 1. And so it's got a correlation very strongly with the S&P market.
Yeah, but that's average.
That's the average for this index. Now you've got other indices that perform slightly differently, and so they're going to have different betas, right? But what I'm doing is explaining briefly how this beta looks so close to 1, or I should say why this beta looks so much like a 1, right? The other thing that's important is that we're talking about systematic risk here. And I think Ben uses the term idiosyncratic risk. If I understand these terms correctly, and I'm still learning like everyone, we're talking about, I think, roughly the same thing. This is just the natural risk inherent in the market, right? When we say systematic risk. And that when you're dealing with alternative assets, you don't have that. And so in this case, they talk about unsystematic risk. And so what they're telling you here is that there's a shortcoming with beta as a sole measurement, and that is it can't detect unsystematic risk. You're really when you're dealing with an alternative asset, there's an element of it that's kind of like apples and oranges, meaning that because it's not detecting the unsystematic risk, beta comparisons can only take you so far when you're dealing with alternative assets. Technically, real estate is an alternative asset, although in this case, they've tried to standardize it as much as possible. So that's just one point to note there. But here's where it really gets interesting, is that when you add a stock or an investment to a portfolio, and this is how you asset managers out there can gauge this. When you're adding a stock or an investment to a portfolio with a beta of 1, so let's say you've got a little hedge fund and you're investing in the S&P 500, and they're now deciding, do I add this stock to my hedge fund? Well, if it's got a beta of 1, it doesn't add any risk to your portfolio, but it doesn't add any excess return either. Okay, so you've got to seriously question whether you want to bother, putting that in the portfolio if you're not getting any return out of it. Okay, so that's something to keep in mind. We'll talk about this a little bit more in a different way here in the next couple of slides, but I wanted to introduce that concept here when it comes to risk. So go to the next one. What happens when you have a beta value of less than 1? Okay, so here we have the MSCI REIT. It's got a beta of slightly less than 1, although it's close enough to 1 that I would say it's probably 1, but it's slightly less. So what is that telling us? So it's telling us that theoretically it's less volatile than the market. In other words, the MSCI beta, or the MSCI investment as a real estate index, is less volatile than the Standard & Poor's. Okay, and so some of you real estate gurus can probably explain why real estate compared to the stock market is less volatile. Okay, and you can decide, why that is the way it is. But that's where you can have a very intelligent conversation with potential investors. If they're big on real estate, you can talk about how it's less volatile than the stock market and so forth. The point that I want to make here about this is that an example of stocks that are less volatile than, say, the market as a whole are utility stocks. And that's because they tend to move more slowly than market averages, or energy stocks. I'm really big on studying some energy stocks right now for some various reasons. And so they're going to have better betas overall as individual stocks compared to the market. And again, understanding beta, it's their volatility in relation to the market. So a beta less than 1 means it's more secure in that it's less volatile. Now, again, there's other measurements we're going to be looking at here besides beta, but beta just tells one story out of that whole portfolio theory, and that is we're talking about volatility, right? Let's look at, let's see, whoops, I'm back to equal to 1. Let's come down here. Let's talk about a beta value that's greater than 1. Okay, so let's suppose a stock's beta is 1.2. If that's the case, it's assumed to be 20% more volatile than the market. Okay, it's going to have a higher degree of volatility risk, obviously. But if you are looking at this added risk, then you can also expect to see an added increase in the return. That in these efficient markets, you've got a good direct correlation for the risk-reward trade-off, right? And so this is where you want to get, what you want to take a look perhaps at other risk-adjusted performance measures, because this is an indicator that's saying, oh, we better be making a higher return on this investment with a 1.2 beta. And the question is it high enough to be, to warrant the risk? Because it's going to be more volatile than the market as a whole, if that makes sense. Now, again, coming back to our MSCI, it's less than 1. And so it's going to be less volatile, and therefore there's less risk. You're probably going to get a lower return. And let's go back and look real quick at that. In this case, the MSCI outperformed the S&P 500 by a half a point on average. And so that's going to be what generally leads people toward. Doesn't mean you're going to definitely say for sure it's a better investment, but right now it's looking better, right? Because it's a higher return and it's less volatile. So there's 2 points right there to consider when choosing to invest between the two. If I was picking an S&P index versus this MSCI index. Okay, but there's more to come. Let's see, let's come down to this last one. Okay, so let's ask the question, what if there's a negative beta? Okay, so some stocks have negative betas. So, it's a negative number, like -1 or something less or more than -1. And so what that basically means is that the stock or the asset or the investment is inversely correlated to the market. Okay, meaning that it has just the mirror image of the market. So if the market goes up, this investment goes down by the same correlation, and vice versa. I put some links there between put options and inverse ETFs to give you a better idea of what those might look like in practical applications. But here's an example. Gold, in some cases, certain commodities might have a negative beta, meaning that they would have an opposite reaction to what the market is doing. And so they are correlated to the market, but inversely. Whereas the lower the beta is with a positive number, it's less and less correlated. So if we had a beta of something really low, then what that means is the market can go up and down and all around and do all kinds of crazy things, and yet our investment won't be moved by that. So that raises a question. Anybody guess what the question is? What's Adagio's beta? Anybody want to guess? So what I did was I brought in the covariance of Adagio, that's RI, and divided it by the Standard & Poor's 500, which is RM. And I'm wondering if I'm choking. And then we're dividing that by the variance of the market, RM, right? So you would take, let's go back over here. Here's the covariance right here. I'm pointing to that with my pointer. There's the covariance of ABL and S&P. And we're going to divide it by the S&P variance right there. Okay. So there you go. We're going to make that division. And essentially, it's going to give us, boom, 0.0048. So what do you conclude? Who wants to make a conclusionary statement about Adagio's beta? What can we accurately say about Adagio in relation to volatility and the market? And why would this be important when we talk to our investors?
It's not impacted by the market, right?
Bingo. You've got a beta there of 0.0048. And so, in other words, the market can go to hell in a handbasket and it's not going to affect Adagio. The market could jump to 60,000 and it's not going to affect Adagio. And so that's conclusion number one. Okay. So if people are looking for an investment that's safe from market volatility, can you recommend Adagio? And the answer is, based on the historic data, yes, we can. Okay. So that's very important. Again, you can use that in a flash roll, right? You can say Adagio's beta is 0.0048, and therefore the market can go to hell in a handbasket, and Adagio is going to do just fine. And people are going to go, what? And you've just made a very true statement.
Hey,
And
Mark,
so,
is that the calculation through 2022, or is that the other one?
No, if you go back and look at the data set, No, this is
That's
still the
through
old
20
data set going
okay.
through 2015.
Okay.
I would like to see him update this and bring in the last 7 years.
Well, Dwayne has one. Dwayne had one.
I mean, I'm sure the story doesn't change. It probably only gets better.
I'm sure it doesn't either, but I
But
was just curious.
nevertheless, yeah, it would be nice to have, it would be nice to have a more complete data set.
Yeah, that it would help us if we had a more up-to-date information or data.
Yeah, it would. It would.
Yeah,
And
I
it's
mean,
all
if we're-
nice.
Yeah, if we,
But I'm not, oh, go ahead, John.
no, if we're presenting to a client, if we're putting that in our documentation, I mean, I wouldn't want to present old data.
Well, you're gonna present all of this
I
data.
mean, old data, but you know what I mean, but
Yeah,
up to date,
yeah.
up to date, up to current, make it.
Yeah, you want to
past
bring it as
current.
current as you can. Yes.
Right. Yeah.
And
I'll see if
so,
I can post it in the chat.
Excellent. That would be cool.
so anyway, but the point is that you can conclude that Adagio is less volatile than the market by a long shot. And the fact that it's such a low number compared to 1.0, then you can also say that Adagio is not impacted by the market. It doesn't, or influenced by the market. There's one more thing that we can conclude from that. If the Adagio beta is not affected by the market and still makes these wonderful returns, again, looking at these returns of Adagio, 26%, 32, 41, 26, 27, 33, 25, 20, almost 21, 27. What does that tell you about the nature of Adagio's portfolio? Anybody want to take a stab at what kind of portfolio it would probably be if it's not affected by the volatility of the market?
Using options.
Possibly, but then again, options are going to be very volatile in relation to the market, right? If the underlying stock,
Depending on how you're structuring it. Think about Mark Cuban and the team that supported him after he sold his program. He sold his company to Yahoo. He put it into they put it into an iron condor hedge. And so they had a certain amount of risk. They figured, hey, I'm trying to remember. I think maybe they were exposed to like 10% of the risk. Let's say that Yahoo was $100 to make it simple. They said, okay, we'll be willing to risk and lose $10, but everything else after that, there's no further downside.
right?
And that's what happened is Yahoo dropped to like $5. But
Right.
it didn't matter because they were putting it to the other parties at $90 as an example.
Right.
Yeah. And
So,
well,
Frenchie, you're right. There's options involved in these structured products, but the return that they're generating, is that based on the option alone, or what are they doing? If you remember how they structure, remember the formula of how Adagio structures a product? He starts out by saying it's a fixed income it's a fixed income instrument, okay, comprised of an option wrapped around an index. So
It's like that. It's like that.
It's like that. It's like that. Okay. So what I would say is these phenomenal returns are based on the fact that, and Finchie is absolutely correct, that they're based on an option.
Well, that's John. You mean John? You were talking.
Oh, John, was that John talking? Okay, I wasn't sure if that was Frenchie or John talking. Okay, so as John was saying, you know, there's an option element into this, but what he's offering is a fixed income instrument, which as a fixed income instrument, in terms of its volatility in relation to the market, it's fixed income. In other words, notwithstanding how the market works, he's going to pay the same amount out, whether the market goes up or down.
So in simpler terms, you're just hedging the portfolio. He's just hedging the portfolio.
You got it.
Yeah.
You got it. We are now uncovering the secret sauce, which is good. Little by little. I can't say we've uncovered it 100%, A lot of it's proprietary, but the bottom line is the more we study this, the more we understand Ben's secret sauce. And it's okay with him that we discover it this way. He wants us, I believe, to discover it this way rather than just give us the secrets, right? But you know, as you think that through and you ponder on these terms, particularly, you know, on the things like beta and some of these others we're going to look at, you begin to start seeing, yes, that's why it works that way.
But hey, Mark, let me, if you mind.
No, go right ahead.
Go back to that the beta value equals 1 sheet for a minute.
All right, let me see if I can find that.
The first one.
There you go.
Now, based on if you gave that presentation, going back, based on what's your definition here, and I understand what you're saying, and but if I was giving a presentation to someone and my question came up, now if you're dealing with beta, I mean, some people use beta. There's another number some people use, but I'm not going to go down that rabbit hole. But they use a CPM number. But based on the beta, in here with a 1, and I guess without going into too much detail, I know we're talking about volatility, whether if it's intrinsic or historic. And I'm not trying to go that deep right now, but at the bottom line, you says because it's a 1, you have a pretty much standard portfolio, but the risk is pretty normal or average. But the last statement says likelihood that the portfolio will provide, excuse me, an excess return. Now, if you have a beta above 1, that gives you the excess return, but you also get the volatility of risk.
That's right.
Right.
That's exactly right.
Right. Now, going back to your point where you did the calculation for the Adagio beta, it went below, it went lower. So mentally, that would say to me, okay, well, if you're going lower in beta, that means less of in excess of return.
Yes.
Normally, that's what you would think, right?
Yes, normally that's what you would think. But this is the magic that Ben has created in doing this, because what he's done is in combining these kinds of investments, you know, and structuring them this way, we get the lower risk of volatility, but with the higher return that comes with something like options. It's just how you structure those things and put them together to make that work.
Yeah, you know that's going against the norm.
Absolutely, it is. Yeah, absolutely, and that's part of the reason why this is, you know, reserved for the elite, right? Because we can't have people going out there and just saving their money at $20 a week, working at McDonald's, and end up retiring in 25 years as multi-gazillionaires. Just can't allow that, right?
If you say so.
I'm just parroting, you know, the Rockefellers and Larry Fink and all those other idiots, right?
Yeah, exactly.
So, okay, let's move on. There's a couple more I want to cover before we give it up for the day. So the next one I want to talk about is the capital asset pricing model, the CAPM, and that might have been what you were referring to earlier, Frenchie, or maybe it was a different measure.
No, that's correct. That's exactly it.
Okay, so this is the mathematical model that estimates the expected return of an investment based on its riskiness relative to the rest of the market. So what does that definition tell us? It's going to talk about average returns. We're going to be using geometric returns, geometric means, I mean, in this calculation. And we're going to be using betas in this calculation. Can you pick that out from the definition? When we talk about expected returns and riskiness relative to the rest of the market. So you can kind of see that the definition is kind of giving away what the formula is going to entail. And so I want to jump down here and let's look at what the capital asset pricing model is. So I'm going to jump over primarily now and focus on Adagio. And then I'm going to come back and compare that to MSCI. I just want everybody to kind of see. So this is Adagio's capital asset pricing model. So where do we get these numbers? I've replicated the formula up above. And so it's literally the expected return of the investment. In this case, I'm using Adagio. And that's equal to the risk-free rate, that's RF, plus the absolute value of the beta, okay, times the expected return of the market minus the risk-free rate, okay? Now that's a mouthful, and I don't expect anybody to memorize it, okay? But I'm just wanting you to kind of see that there's actual things working here, right? So let's go back up here and look at those components. First of all, let's look at RF. That's the risk-free rate. And the risk-free rate is going to always, always, always be the risk-free return of a 10-year T-note as of a certain date. So for example, if we were doing this analysis today, February 21st, we would pick the 10-year T-note as of today, February 21st. Now, in this case, the analysis was done back in December of 2015, okay? So Ben selected the T-note as of that date, which happened to be a 2.27% return. So in all of his calculations now, the risk-free rate is going to be 2.27%. And so if we look at the formula, there you go. There's your risk-free rate right there, okay? There's your risk-free rate over on this side, okay? So that's pretty straightforward. The other thing is we're going to look at the expected return of the market, okay? And so the expected return of the market is 6.4%, okay? That's just your average for your geometric mean over here. So 6.4% is your expected return for the market. So if we come down here, there's your 6.4%, okay? And then lastly, if you remember, our beta is 0.0048. So there's the mathematical components to calculate the capital asset pricing model, okay? So let's just go through and do the math. So the first thing is I did everything in the parentheses, right? Then I'm multiplying it by our beta here, which is a multiplication, comes before addition. So I do that and I get this crazy long number. And then I add that to the risk-free rate. And so our capital asset pricing model is that in order for Adagio to be a good risk, you might remember back from last time, we talked about flipping a coin and how the payout had to be $2 if you're going to invest $1 on a 50% chance of success, right? So in this case, for Adagio to be considered a good risk, the minimum return that an investor should be willing to accept is 2.29%. Okay? Anything over 2.29% is going to be considered by the investor gravy from a risk perspective. Does that make sense? Anybody have any questions there? So let's take a look at the conclusion here. The required return, that triple R there, is the minimum return an investor will accept for owning an Adagio investment as compensation for the amount of risk that they're putting out there for holding on to it. Okay. So, and I've got some links there if you want to follow those links to look at the definitions of required return. Okay. So that's pretty cool. Let's just compare real quick the capital asset pricing model for Adagio compared to MSCI. So if we come over here and we look at that 2.29, here's that expected risk-adjusted expected return. The MSCI is 5.64%. Okay, using the same formula. So you look at the MSCI's actual average return of 6.92. And then you're going, oh, and I have to make a minimum of 5.94 to cover my risk. Doesn't leave you much margin, does it? You know, if you want to think of that as cost of goods sold and gross margin or gross profit, doesn't leave you with much. Okay. Whereas again, Adagio's expected risk adjusted return has to be higher than 2.29%. So we have a very low hurdle from a risk standpoint that we have to overcome. Whereas MSCI has a much higher return compared to the return that they're giving. Does that make sense? Let's go on to that. All right. Let's come down and talk about alpha. This, by the way, this builds on itself. So each one of these is going to give you more analysis to consider. Okay, so let's jump down to alpha for a second. So the alpha is a term that's used in investment to describe an investment strategy's ability to beat the market. Okay, so when we have an alpha down here, let's see, our alpha right here is 26.65 versus 1.28, right there, right below that red line. Okay, and the alpha is simply the difference right here. It's the expected return minus your market risk, and that's your risk adjusted performance. So if you look at, if you remember, Adagio got an average return of 28.94% over those years in our data set. Now you subtract from that the capital asset pricing model. That's the minimum it has to earn to meet its risk hurdle. Okay, what they make over and above that risk hurdle is your alpha. That is your gross profit or gross margin in this case. So alpha refers to the excess returns earned on an investment above the benchmark. The benchmark is that risk rate. Okay, so Adagio makes 26.65% return. Okay, and those are 26.65 points above the minimum that an investor should expect to make on an alpha investment. Okay, where are we with MSCI? As I said, it's 1.28%. So the 6.92% average that MSCI does has a 1.28% excess, or 1.28 points above the minimum it needs to make in order to surpass the risk that the investor is taking. So when you're looking at risk and you're looking at return, okay, which is the better investment? Okay, first of all, Adagio has a lower hurdle, 2.29, and it makes this humongous amount, thanks to probably the options, over and above the minimum required. And whereas here you have this real estate index and we think, oh my goodness, we've diversified into a million different real estate projects. That's got to be really safe. It makes you a whopping 6.92% annually, and you're only getting 1.28 points above the minimum risk threshold. Jody's sitting there shaking her head. She's like,
I think the frustrating thing is, like, most people don't know this, or if they did, there would be no stock market.
Yeah.
Like, no one would want to do this.
Well, I'll tell you what, if Larry Fink and Joe Biden get their way, there will be no stock market in the not too distant future. But that's another topic for another day. So anyway,
but I mean, most people have never heard of these calculations yet, and myself included. I'm not in yet, and don't know how to apply them. I mean, it's mind-boggling to me.
Yeah. Well, I hope you guys will go back and rewatch this one. This is one that you might want to rewatch 2 or 3 times because again, we're delving into a level of detail that I know it's a lot of math. I know a lot of people, you know, when they see math, they see a formula like this. I know my eyes do it too. I look at it, my eyes glaze over and, you know, and it's like, okay, just tell me what it means, right? But I'm telling you, I spent today, you know, putting this presentation together, unpacking these formulas. And the more I unpacked them, the better I understood it. And the better I understood it, the more I realized what an amazing opportunity we have, not only in terms of generating good returns, but when it comes to bringing in investors, this should be a no-brainer. They should be no-brainers.
It should be, but it's a whole re-education.
Yes, it's how we explain this. And
Yeah,
so
yeah, Jody, the thing is that a lot of people don't take the time to go through it and do it.
Well, but I think there's a false sense of trust, right? Well, my financial planner said to XYZ and I'm diversified and I'm this and I'm that. And financial planners don't even know this crap.
Mhm.
And they're just pushing a product on people, which was my biggest problem when I got my Series 6 was I'm like, wait a minute, why am I going to push someone into a product I know that when the market tanks their stuff, they're going to tank? Like, why would I want to do that? And that's why I'm no longer associated with the company I'm with, and I chose not to do that because it wasn't right to me.
Right. But anyway, this presentation right here, guys, will help you develop your flash rolls. Dwayne, I don't know if he's on tonight, but Dwayne put together a narrative that explains, you know, Adagio's alternative assets in a way that I have never seen before. That's just fantastic. And he's making that available to everybody. And I don't know if he posted that in the community or not, but
I think it was only for people that attended the lab. See, you got to attend the lab.
Okay, maybe it was. But even so, if you didn't attend that lab and you want to get your hands on it, then I would just, get with Dwayne and,
he might take bribes. I don't know if he likes
yeah, he'll probably take a bribe, an ethical bribe.
Yeah.
And he'll probably give it to you.
That's fun.
But it's absolutely beautiful. But when you combine his marketing language with a flash roll that you could pull out of all of this, you've got the tools you need to be able to explain this to people in a way that they're going to go, oh my gosh, where do I sign?
When are the labs?
On alternate Tuesdays. So next week will be a lab. And
oh, you mean the same? Oh, I mean, yeah. Well,
yeah. Every other week is a technical presentation like this, and then on the off weeks, it's a lab where people are kind of just talking more informally about their projects. And Dwayne put up a marketing piece based on his website of some language, and that's the other thing.
The GP stakes one was fantastic. Like the way he explained
Oh, the way he explained GP stakes was just nothing short of marketing genius.
Yes.
are they recorded?
They're on his website.
Document.
So if you can get his website, I think you'll get what you need there. So
I'm borrowing it for our website.
oh, absolutely. I asked him, I said, can I swipe this? And he said, it's for everybody. So I know he'll let you have it if you ask him.
Okay.
Yeah.
Hey,
But,
Jody, can you post that again? I tried to click on it and it kicked me out of Zoom.
Oh,
Yeah, the PDF file that you just posted.
yeah.
I'm sorry, interrupt, but
oh, no problem.
No, that's
no
okay.
problem. This is good.
because I just got back in because I tried to download it and for some reason my Zoom just shut me out.
Hey, Mark.
But go ahead.
Yeah.
Not to interrupt you, but we've been looking at a lot of this BlackRock stuff.
Mm-hmm.
I don't know if you noticed their fund performance.
No, I haven't looked at. I haven't done it. That's a great idea.
Oh, my goodness.
I'm gonna do a risk performance adjustment
I'm waiting to hear this
analysis on
number.
BlackRock and see if we can do an apples to apples comparison of BlackRock versus Adagio.
Their 1 year return and their alternatives was
Mhm.
1.41%.
Oh my goodness.
Of what?
Of investment.
I mean,
So if you
yeah,
put
but
in $100, you made $1.40.
what?
If
Yeah,
you put $100 into BlackRock, you made $1.40.
Yeah, but
And
their
they're-
fund is huge.
this is their alternatives. So this is the
Their
same
alternatives.
stuff.
This
Oh.
is their product that is in direct competition with us.
Oh,
With our alternative asset portfolios. You know, if we're doing a fund of funds and it's based largely on Adagio products, then we're going to be competing with BlackRock with this fund.
It's
This
their
fund
black,
of funds will compete with BlackRock.
well,
their
we're gonna
BLK
crush 'em.
private investment funds.
Yeah, we're going to
right,
crush
but they
them.
have so many funds though. I mean, because
Oh yeah. But I'm just
But
saying.
this is what they're touting as their alternative. So it is the
Yes.
direct competition to what we're doing.
okay.
Yeah, I thought you'd find that their 1 year return was 1.41.
Oh, I love it. I love it.
We've got to
have to-
put that in our,
Wow. Wow.
And one of the things we ought to do is also take a look at Aladdin and see what its track record is going back to 1996 or whenever it came out, and look at their risk-adjusted returns that way, and see if we creamed them that way. Even though it's not necessarily, it's probably more hedge fundy, private equity, type stuff.
yes, we
interesting to
should
see.
do that.
Yeah,
Yeah.
I think I will play with that, but I'm going to get my legal docs done first. By the way, I did make progress this week in getting them done. They're very, very close.
Well, you
My
saw I got the,
perfectionism is just kicked in, and I'm now trying to tweak them.
I've got the presentation done. I totally lifted BlackRock.
Yes, I saw you had that. I resisted the I was like Ben. I resisted the temptation to open it and look at it right away. I knew that I would not get this presentation done today if I did, so I'll look at it tomorrow.
Yeah. But
Anyway,
I
let's look
digress,
at-
sorry.
Do we get a presentation?
You got to come to the lab.
Yeah, she's gonna do the pitch. She's gonna do a pitch here next week or the weekend, the next lab or so.
Okay. What time is the lab then? What time?
Same
is it?
time.
Same time.
It was the same class I've been coming to then, isn't it?
Yeah,
Yeah.
except if you'll notice, every other week we have a technical conversation like this.
Yes.
And then on
correct.
the off weeks, we have a general mastermind meeting. And
Yes.
we call it
I
the
like
lab. It's a
should-
mastermind meeting designed to get people to talk about what things they need to get done and
Oh,
help
okay.
they need.
All right. So I haven't missed it. Well, I've missed it.
You haven't missed anything.
Okay.
And
fact, You were probably at the lab that Dwayne made that available.
No, I think I missed that one. I know
Oh,
I missed
okay.
that one. Is that the one I came at the end? Well, not at the end, but
I don't know, but like I
Yeah.
said, circle back with Dwayne. He probably
Yeah,
more than happily.
well, I owe him a
Provided
call.
you.
He called me, so I owe him a call anyway.
Okay.
And we're looking at having a special guest,
Oh.
Stefan Piscano. coming
Oh, yeah.
hopefully
Yeah.
in March.
Nice.
So
Yeah.
stay tuned for that. But yeah,
Wow, that'd be
I
great.
like it, Mark. We need to announce our masterminds. I like that.
Yeah, we do. We need to
Excellent.
promote them. So good. All right. I have one more measurement to share with you tonight, and I'll get through it fairly quickly, and then we can kind of summarize and wrap it up. The last one I want to show you tonight is the Sharpe ratio. I really like this one. I had a lot of fun spending time analyzing this. But the Sharpe ratio is a measure of the investment's risk-adjusted performance calculated by comparing its return to that of a risk-free asset. Okay, so this is a good equalizer in terms of coming up with how good it compares to other investment opportunities. So let's jump down to the formula here and see what the Sharpe ratio formula looks like. So the Sharpe ratio is the expected return of the investment. So that's our average or our geometric mean of 28.94%. It subtracts the risk-free rate or 2.27%. And and it's divided by the standard deviation. Now, again, the standard deviation is one of those process measurements that you can calculate. You take the range of the data. In this case, it would be the range of your investment data, highlight it, and then in Excel, click on statistics, and then click on standard deviation, and it spits out that number. So it's a very easy number to calculate. Okay. So in this case, we would literally take 28.94 minus 2.27, and then divide that by 5.82%, and our Sharpe ratio is 4.6. And so again, the question is so what? What does that mean? Okay. Is that good? Is that bad? Who knows? Anybody want to hazard a guess? Is that a good Sharpe ratio or a so-so Sharpe ratio? Well, let's go see what William Sharpe has to say. He's the Nobel Prize winning economist that came up with the Sharpe ratio. Okay. And so William Sharpe said basically a Sharpe ratio greater than 1 is considered acceptable to good by investors. A ratio that's higher than 2 is considered very good. And a ratio of 3.0 or higher is considered excellent. Okay, and then just for giggles, he says, and by the way, a ratio under 1 is considered suboptimal. Okay, where are we? This is Adagio. Boom, 4.6. It's got a killer Sharpe ratio. Okay, now, anybody interested in comparing that to the MSCI index? What's their Sharpe ratio? Anybody want to guess? Let's come down here. Right there. Can you see that? 0.216. Point right at it with my pointer there. 0.216.
Nice.
So it's a sub one Sharpe ratio. And it's very low. I mean, it's like 21% of 1. Okay. So what's the Sharpe ratio again telling us? It's telling us, we come back here and look at the story, it's taking our average annual return, our geometric mean, and it's reducing the risk-free rate. So that's that amount over and above the risk, right? And dividing that by the standard deviation. Why does that matter? The standard deviation is what creates those annual year-over-year fluctuations. Okay, that's your standard deviation from the norm. Okay, so it's saying allowing for those typical fluctuations, let's fold that into it and say, okay, allowing for that, what can we expect to happen in any given year? Okay, and the Sharpe ratio tells us that we can expect an excellent return based on this. Okay, so what would indicate a high degree of expected return for a relatively low amount of risk? And that is the definition of Adagio right there. So, you know, when you've got someone like Ben who is putting together structured products, he's not just kind of going, well, you know, how might this turn out, you know, by guess and by golly. He's literally designing or engineering these things to meet or beat these expectations from a modern portfolio theory standpoint. And that's why they do, because he's designed them that way. So that's basically the sum and substance of what I had to share tonight. What do you guys think? Was this eye-opening at all?
It was very good, Mark. And, you know, it's going to make reading that white paper that Ben just did a little bit easier. Because when I first started looking at it, my eyes glazed over.
Yeah.
Like, I don't understand.
Yeah. Well, the challenge I have for everybody is that instead of having your eyes glaze over when you see formulas like that, you know, try to unpack it. because the formula is based on a standard approach. You know that this is always going to be the risk-adjusted return or the expected return, right? This is always going to be the risk-free rate. Whoops. Okay, this is always going to be the standard deviation. And they don't change, you know, for that particular data set. And so you're able to take something that says Sharpe ratio, plug in those parts, because if you calculated a spreadsheet, and by the way, Ben's spreadsheet that he designed that everybody, you know, refers to, that he you can subscribe to it on a monthly basis. It's all of this. Now there's a lot more that we need to go over. This is just an introduction. Okay. But I wanted to do enough of an introduction to show you guys what kind of story we tell. And just, you know, these first three things, you know, the beta, the alpha, the Sharpe ratio, even the CAPM, the capital asset pricing model, all four of those items tell an amazing story, you know, and they build on each other. And so we're going to have more coming. And again, I'm not trying to make anybody an expert. Don't feel like you have to know this stuff to be able to set up and run a fund. You don't. That's why we have Ben. But I wanted you to know just enough to create some flash rolls for yourself, whatever you feel comfortable talking to investors about. So that, you know, when somebody says, well, you know, what is the Sharpe ratio in your opinion? What's the Sharpe ratio in relation to, say, the S&P 500 or a real estate index, right? Take one of the top performing real estate indices and say, what's the Sharpe ratio of that compared to the Sharpe ratio of Adagio? You know, and that ought to tell you right there that Adagio is going to beat real estate hands down every single time. Now, you might get a really killer real estate deal that when you study that and you calculate all of this information, it might be comparable to Adagio's performance. But I'll tell you what, Adagio is setting a pretty high standard. You know, it's going to be tough. It's going to be tough.
Yeah. Well, this is the thing, Mark, and I think I said it last time, that it's like perfect timing, because I was going through this trying to figure out the best way to get up to speed on exactly what his process is and his methodology in order to present it. And if you don't know the language, how can you present it?
This gives you some of that language. This gives you a really good start on some of that language.
Right.
Mark, do you know, like other investments out there, do they even have these formulas like beta and all that? Like if you
oh yeah, this is again, this is investment agnostic.
Yeah.
The modern portfolio theory has existed since 1952 for all investments.
This has been out there for a long time.
So
Yeah.
if we go like to Morningstar or whatever, and we see a certain stock or whatever, they'll have these formulas.
Theoretically, they should. But again, to your point, Jody, how many people just don't even bother going here because they don't really understand it enough to make the effort and spend the time to do it? Now, I would have to believe, and you know, and I'm just speculating here, but I would have to believe that a lot of your funds, you know, your mutual funds, your higher tech investments, you know, in the stock market and things like that, probably have this information. You know, if you get deep into the prospectus,
Right.
you'll probably find this.
Yeah.
Right.
Yeah.
But you have to dig deep.
Yeah. Most of them have it. If they, the thing is that each portfolio has their own theory that they use.
Yep.
And you have to, unless you are, and a lot of times a layperson doesn't really understand the detail, like Mark said, the details of the theory behind it. But I guarantee you, and I know for a fact, that they have someone on staff who does this analysis for them.
They've got quants on Wall Street.
They got quants.
All they do
on.
is they spend their time
That's
you know,
right.
calculating this kind of stuff. So, you know, I would have to guess that if you got a mutual fund, in fact, try this. Find a prospectus on some kind of investment that you're invested on, get the perspective, crack it open, and see if you can find some modern portfolio theory calculations in the prospectus.
Right.
And see if you can unpack them to the point where you understand what they're saying. Now, the difference is that your typical RIA, your FINRA certified RIA, does not understand this. And so why would they go deep into a prospectus and unpack it if they don't even understand it?
Yeah.
You know, they're just going to say, hey guys, this is a good return. You ought to get it, you know, and they convince them to do it based on things like dollar cost averaging and, you know, all the things that people tell their clients, which is, you know, kindergarten stuff.
Yeah. And some of them even consider it to be proprietary in certain
Very possible. Very possible.
circumstances. Yeah.
But, you know, the fact is that your high net worth individuals, first and foremost, are going to be much more sophisticated
Right.
than your typical investor. You know, your typical doctor, lawyer, Indian chief who's too busy to get into the inner workings of their investment. One of the reasons why they're a high net worth individual is because they watch their investments much more carefully and do a lot more due diligence than the average bear, right? But if you can sit down and talk to them at this level about, you know, their due diligence, you've got the deck stacked in your favor to convincing them that this is the better deal. And we're all going to be doing that at some point in the near future with our funds. We are going to be talking to high net worth individuals. You know, John's going to be talking to the Tennessee state legislature. Dwayne's going to be talking to the Louisiana state legislature. You know, and these people are going to want to be flash rolled, right?
Yeah.
They're gonna want you to basically show this is why this is such a better investment. You need to change your laws in terms of how you go about deciding what things to put in your portfolios, people.
Oh, this is the case. Oh, this is the one where they were talking about was it the pension funds? What was it? Is that what Dwayne? I think Dwayne was.
Oh yes,
talking about
yes,
it.
yes. Uh-huh.
I think there was something, yeah, that the state or the local government was trying to do. Yeah, that was very interesting. I thought that was very interesting.
So yeah, it's
I'm gonna
important
Mark,
yeah.
when you are finished and stop recording, I'll share a little bit of what's about to roll out, if that's okay.
Yeah, actually,
yeah.
John, you were.
Don't stop recording before you're finished. Okay?
Actually, I'm finished with the presentation unless anybody has any questions about, you know, about what has been presented. I would be more than happy to end the recording and take the meeting private.
Yeah, and John, that's John. Wasn't it you and Dwayne having that conversation, right?
It was, yes.
Okay, that's what I thought. Yeah, I forgot about that. Yeah.
Okay. Well, if no one else has anything to add to this, I'll stop the recording now, and then I've got about 5 or 6 more minutes that I can hang around, and then I've got to go.
Okay, Jody, can you post that for me again? That file.